Did you know that, based on her extensive research and experience, investor Cathie Wood has issued a dire warning regarding the financial industry? You would not want to ignore what Wood stated, so you should pay attention to what she had to say. We think there has been a policy error made by the Fed. The Fed should take a moment to consider the various catalysts that we are seeing, according to Cathie Wood. It should lead to a complete policy shift and reversal, if not a stop. The markets are alerting us to the fact that they are making a mistake, which they are. If they continue to follow the CPI, a lagging indicator, I believe something will go wrong that affects them. The founder, CEO, and CIO of ARK Invest, an investment firm with $60 billion in assets that makes bets on cutting-edge technologies like genomics and self-driving cars, is Cathie Wood, an American investor and celebrity stock picker. One of the most underappreciated investors in the industry is Cathie Wood. Her investment ideas are not only highly appealing, but she also has the track record to support her shockingly astute assertions. Cathie Wood offers monthly updates on a variety of topics, including innovations, expectations in her area of expertise, monetary and economic policy, and her thoughts on Fed decisions. The United States Central Bank, the Federal Reserve System, or Fed, is in charge of overseeing the country's financial and monetary systems. The Fed hiked interest rates in June, the largest one-time increase since 1994, by 75 basis points to 1.5 to 1.75%. It is anticipated that rates will rise by an additional 75 basis points later in July. One CME FedWatch tool priced the likelihood of that happening at 90.6%. Wood believes that the Fed should be concerned about deflationary forces and considers this decision to be a mistake. There are all kinds of deflationary signals which are going to force the Fed, we think, to pivot and reverse its policy, said Wood. Deflationary signs include movements in gold, the U.S. currency, oil, copper yield builds, and trading patterns. Gold, which is sometimes seen as an inflation hedge, has dropped below the $1,723 per ounce mark over the last few months, losing about 12% of its value. Wood noted this trading pattern does not support the inflation narrative. Cathie Wood cautioned that the U.S. was already experiencing a recession in late June. In an interview with CNBC, Cathie Wood, the CEO of ARK Invest, acknowledged that she had misjudged the level of inflation and went on to suggest that the U.S. economy is probably now in a recession. Wood attributed the increased price pressures beyond her initial projections to supply chain interruptions and geopolitical concerns such as the conflict in Ukraine. She added that a recession had already started, partly due to poorly managed inventory. We believe that we are in a recession, Wood stated in an interview with Andrew Ross Sorkin of CNBC. We believe that inventories, whose growth I've never seen this significant in my time, are a major issue. I have 45 years of experience. The investor who prioritizes innovation claimed that supply chain disruptions and geopolitical concerns are to blame for the unexpectedly high rate of inflation. According to Wood, problems with the supply chain caused big merchants to mishandle their inventory, which resulted in an abundance of some completed goods, such as furniture, which was in high demand during the epidemic. She claimed that issues still plague even the world's most well-run businesses. She continued by saying that in her 45-year career, she has never seen a spike in inventories like the one that has occurred during the last year. Wood maintains that inflation is still a transient issue. This becomes clear when investors start paying closer attention to how gold, the US dollar, and yields have been trading, Wood stated. Wood stated at the beginning of July that gold had broken down to the lowest point in its range and has been one of the most accurate indicators of inflation. Regarding gold prices, Wood said, "That will confirm in my mind that deflation is the greater risk here, not inflation." Noting that the US dollar index is trading at 20-year highs, she continued, the latest strength of the dollar is even a bigger sign of deflation. In addition, the 10-year Treasury yield remains around 3%, while the price of oil has dropped by roughly 20% this month. Demand has not increased above 2019 levels, as the global economy is still in recession and even oil is beginning to falter despite the events in Russia. Supply has been impacted. As of right now, oil is down 22% month over month at $96, she noted. Another example is copper, which is used as a barometer of inflation and actual activity. According to Wood, all of these indicators suggest that the inflation issue is exaggerated. If we are right and inflation unwinds pretty dramatically during the next 6 months, that should help growth, Wood stated. We were strong on one thing, and that was inflation being as sustained as it has been, Wood stated. The supply chain, the invasion of Ukraine by Russia, and the unbelievable delay of over 2 years. Naturally, we could have seen that inflation was a more significant issue, but it has made deflation more likely. To put it more simply, A recession is a contraction of the business cycle that occurs when there is a broad downturn in economic activity. It is a brief period of decreased trade and industrial activity that is typically indicated by a dip in GDP over the course of 2 quarters. Recessions typically result from a sharp decline in consumer spending. The rate of price growth during a specified time period is known as inflation. Usually, inflation is measured broadly, such as the total increase in prices or the rising cost of living in a nation. Conversely, when the inflation rate drops below 0%, there is a decline in the overall level of prices for goods and services, which is known as deflation. Over time, inflation lowers the value of money, but abrupt deflation raises it. We know that innovation in the public equity markets, not the private equity markets, has been ravaged in the last year, Wood stated in a recent interview. It has been devastated for about a year now, and Raoul said that when expectations changed, people believed that the economy would open up. Interest rates would rise and inflation would rise, but would eventually level off. The problems with the supply chain persisted last year in spite of the modification. Nevertheless, worry over the impact of rising interest rates and inflation initially dominated the innovation sector, but it now appears to be having an impact on the market more widely, according to Wood. I think the fears here are going to shift from rising interest rates and higher inflation potentially to recession, especially, and you've heard me on this before, because we've seen inventories piling up throughout the ecosystem. While other investors fear that the United States may see a recession next year, Wood claims that innovation stocks in the public equity markets are down to 50% from 75% last year. Cathie Wood, founder of ARK Investment Management, believes that one hit has already occurred and that it may end in the coming year, although a lot of strategists and economists disagree that we are in a recession and believe that the United States may have one next year. We actually think we'll be coming out of it in 2023, Wood stated. Professor Jeremy Siegel of the Wharton School of Business concurs with Wood that the United States is currently experiencing a recession. Siegel stated to CNBC that the first half of the year's economy most certainly shrank. I think we're actually in a mild recession, he stated. He stated that he is keeping an eye on evidence that show the economy may slow down in the 3rd quarter. In particular, he mentioned statistics indicating the drop in the U.S. money supply suggests we are beginning to control inflation. According to Wood, there are many signs that prices are beginning to decline, and she believes that the inflation that has everyone concerned is not the correct way to view the situation at the moment. She underlined their conviction that the greater risk is deflation. We believe that deflation is a much bigger risk, Wood states. She continued by stating that they had been making this claim for some time, during which they have faced criticism and even challenges from those who firmly believe that the United States was headed for inflation like to that in the 1970s. Despite worries, the majority of people think that Tesla is not significantly harmed by a recession. Economic downturns usually result in a sharp decline in sales for automakers, but Tesla's business is predicted to do far better. The adoption of EVs is still in its very early phases, and demand for Tesla has typically outpaced supply. Tesla had previously stated that it will expand deliveries by more than 50% over a number of years, and it may rise by as much as 60% this year. This suggests that demand growth should continue even in the case of a downturn. Be sure to subscribe to this channel in order to receive updates on advisories from professionals such as investor Cathie Wood.